Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. It sounds like I'm losing my voice. This is, I guess, evening edition of the live Q&A. I thought I would try it, and so here we are. So I see that there are already folks in the chat. Welcome, and it would be great if you could give me a thumbs up that you can hear me. Looking at my hair, it's almost like I just woke up and crawled out of bed. Thanks, Rick, for the thumbs up. Appreciate it. So I already see some questions in the chat. That's great. And I'll get to those. I published a video earlier today about something that Vanguard did. And I want to sort of follow up. Some of you may have watched it, but if you didn't, it's a really important issue. And so here's what I can actually show you. I'll show you this in Morningstar. So it has to do with Vanguard's 2035 fund. Actually, other target date funds as well. But we can look at this as an example. Talked about this a lot in the live shows recently, that whenever you invest in a taxable account, you need to understand what the tax ramifications are of the investment. And so there are certain things like, don't put a REIT in a taxable account, or don't put a municipal bond fund in a tax retirement account. But even within something that you might expect to be reasonably tax efficient, there can be some gremlins, some tax gremlins lurking. And so how you find it, so there's two ways actually. Let me show you. I'm going to show you both. Actually, I'll do it this way. Vanguard, I'm just going to Google, and I'll show you this on the screen. 2035 fund. I'm going to show you this in Morningstar and on the Vanguard website. Yeah. All right. So we'll start with Morningstar. So we're looking at their 2035 fund. And we go to performance, and initially what you see is just the returns, right, of the fund compared to different things. But what we want to look at is distributions. So this is the link. And this shows us the distributions. It shows us income, which would be either dividends or interest, or in a balanced fund, which is what they call a fund that invests in both stocks and bonds. And that's what a target date fund is. Income would be both dividends and interest, right? It's fine. We expect that. No surprises there. But you'll see it has short-term capital gains and long-term capital gains. And here's the thing we have to remember. Normally, we think about capital gains as being triggered when we decide to sell something, right? So you buy Berkshire Hathaway, and hopefully 40 years later, you sell it, you're rich, good for you, and you pay capital gains. But until you do that, right, no capital gains. But that's not true with mutual funds. They can, just like they can distribute income. We see that here. And I hope you guys can see this. Let me make it a little bigger, maybe. Okay. So they can just like they can distribute dividends and interest, and they do, they can distribute capital gains. And they occur because there's buying and selling within the fund that generates these capital gains. Now, normally, even for a target date retirement fund, even though it might have some capital gains, we can look at 2020. This was what? 6.5 cents, almost roughly 15.5 cents on a $25 per share fund. At least that was it. That was its NAV at the time it distributed those capital gains. And you can see, we can hover over one. It shows you the breakdown each year. And everything is reasonable. I mean, it may not be the most tax efficient investment, but it's not horrible. But you may have been noticing this guy right over here. It's like, oh my word, what happened? And that's the problem. And that's what my video that I published earlier today was about. This giant disaster for tax purposes. By the way, we can see these distributions on the Vanguard website. And you can do this for Fidelity or Schwab. You would just go to the fund's website. And you'll find some kind of tab or link for distributions. And then you can see they break it out. Here are the dividends. So for, let's see. Yeah, so these first three are all last year. They paid almost 56 cents in dividends. Let's go over to Morningstar. Yep, they got it right. There it is. That's what matches up, right? Those were dividends. There's probably some interest in there, but in any event, short-term capital gains, they paid what? 0.0126. There it is right here. And the big whopper, the big thing here, long-term capital gains, $4.08 and some change. And there it is. So Morningstar got the numbers right. So that's good. But, I guess it's important to get the data from the mutual fund company itself to be just double sure that it's correct. Not that I can't say I've ever seen Morningstar get it wrong, but I guess anything's possible. And so it raises the question, well, goodness, this fund was, doing reasonably well with distributions all the way back to 2017. What in the world happened? Now, one thing I need to stress, that only matters if you hold this fund in a taxable account. If you've got a 401k at work, or you've got it in an IRA, yeah, you still got distributed these capital gains, but who cares, right? There's no tax consequences. You can just reinvest it or, doesn't matter. But if you own it in a taxable account, you got walloped with taxes. We're talking, 15% capital gain hit, in terms of how much was distributed relative to the share price. And I was alerted to this from a Wall Street Journal story, Jason Zweig, and he had referenced someone who's going to pay like 150 grand because they had like $3.5–4 million in a taxable account with this fund. Since I published the video just a few hours ago, I've gotten a number of comments and/or emails from folks saying, "Yeah, I got walloped, and I wondered what happened. I had no idea what happened. Sitting there minding my own business, enjoying life, and bam, Vanguard sends me a present for Christmas." And so what happened was this. Vanguard often has, this is true of Fidelity, or, this is not unique to Vanguard. They will have sort of the regular mutual fund shares for like you and I, regular folk. And then they'll have institutional class shares. These are, the institutional class, you're going to need $100 million is a minimum. They have some that are 5 billion is the minimum. That's billion with a B. Well, they have those sorts of institutional class shares for target date retirement funds at Vanguard. At the end of, in 2020, you had to have 100 million. So you could think of like a corporate 401k plan. That's a big company and they've got a lot of employees. And so they can put them in these institutional class shares, and they're a little cheaper. It's not dramatically different, but cheaper is better, right? So I think it's 14 basis points for what you and I would pay, 9 basis points, I think, for the institutional shares. Well, what they did at the end of 2020 is they took that $100 million minimum for the institutional class of shares and dropped it to 5 million. Now, on the surface, that seems like a good deal. I mean, it lowers fees for smaller companies, right? They might not have 100 million, but they've got 5 million, and that in turn allows folks like you and me, maybe in a 401k, perhaps, to get lower fees. The problem is, when that happened, a lot of the companies that had the regular old 14 basis point fund said, "Oh, I now qualify for the institutional. I can take my corporate 401k or whatever. I can move it over to this cheaper 2035 fund." But to do that, they basically had to sell a bunch of Vanguard had to sell a bunch within the fund of the investments it owns to redeem those shares and move them over to the institutional class. And that generated all the capital gains that we now see in this pretty little bar graph. And so if you held this fund in a taxable account in 2021, in December, when these distributions were made, December 29th, yeah, you're going to own a lot of taxes. And I still am very upset with Vanguard. I think I got to believe there are ways they can manage it. I mean, for starters, don't go from 100 million to 5. Spread it out over a few years. Or, you're going all the way down to 5 million. Just make it 9 basis points for everybody. I know there's, realities. They got to generate income to pay the expenses. Maybe that's not feasible. But surely they didn't have to do that to the individual investor. The response, according to the Wall Street Journal article, was, well, you shouldn't hold these kind of target date retirement funds in a taxable account anyway. And while I can't disagree with that view, they were reasonably tax efficient. But more importantly, the reason folks got walloped in 2021 was not because they're a target date retirement fund. It's because of what Vanguard allowed to happen, effectively favoring their institutional clients over regular retail investors. I suppose they could argue, yeah, it favors institutional investors in a way, but that ultimately is beneficial to regular employees inside these 401ks, for example. And so maybe that's maybe a fair point. I was concerned though that this could happen with regular old like S&P 500 index funds, and I mentioned that in the video. I've since been chatting with Rick Ferry via Twitter. He doesn't think that would happen. He thinks would probably only be an issue with balanced funds like these target date retirement funds. Whether that could be an issue with like a life strategy fund, potentially in theory, I don't know. But it kind of, my conclusion was, as much as I kind of do prefer mutual funds because I don't have to deal with the premiums and the discounts, and they always trade at NAV, that if this kind of thing could surprise us, I'd probably just as soon own ETFs. And by the way, you can, as I mentioned in the video, you can convert mutual fund shares from Vanguard mutual fund shares for some of their funds over to ETFs without triggering taxes. That's not tax advice. Talk to Vanguard, talk to your tax professional to make sure. But yeah, so that's what happened. I'm not very happy about it. I didn't own any of these funds in my taxable account, but it's not really the point. I do want to talk about the crazy market. I'm guessing someone's going to ask me a question about like what we're doing. Oh, look at this. The S&P actually closed up a little bit. That's amazing. Okay. All right. Enough chit chat. What do we got? I don't know if I'm seeing the beginning of this chat. I guess I am. Naranjan, and I'm sure I've butchered that name, and I'm sorry. In a state with no income tax, why can't I go further up? So I think I am cutting off one of the questions, but I think I remember it. And it was, what would be the tax consequences of living off, say, VTSAX, which is Vanguard's total stock market fund, in retirement? You've got a state that doesn't have any income tax. Well, and the answer would be, well, it would depend, first of all, in what type of account you owned the investment. Is it a taxable account? In which case, you're going to pay at a federal level dividends or taxes on any distributed income, like we just saw, mainly dividends in the case of VTSAX. At least in the last number of years, it's never distributed capital gains. I guess it could, but you're going to pay, the dividends you earn are going to be capital gains. I don't know if at a state level, do some states have no income tax, but still tax capital gains? You have to, look at your state for that. And of course, if you sell some shares, if you need more than just what the dividend pays you, you're going to pay, if you've held it more than 12 months, long-term capital gains on the gain. You'll have basis, what you paid for it. And there's different ways to calculate that. But you're going to pay the gains on it. If it's in, say, a traditional IRA, anything you take out, will be taxed as ordinary income. Again, maybe not at the state level, but at the federal level. So I hope that helped. Of course, if it's at a Roth, it's tax-free. Again, assuming you meet all the requirements. So it kind of depends on what type of account it's in. If it's in taxable, are you selling shares or not? Are you living off the dividends? Yeah. Kay Thomas, what do you think about covered call ETFs for monthly income, like QYLD? I'm not a fan. We can look at QYLD. Let me pull it up. Yeah, so here it is. The Global X NASDAQ 100 covered call ETF. So you think about a covered call. So what's a covered call? So we'll just use an example. We've got Apple at, what's it trading at? 150 bucks. It's been down. Well, 161. All right. It's still been down. So I can sell, the idea of a covered call, let's say from the seller's perspective. So I'm going to sell someone this covered call. One contract is going to cover 100 shares of Apple. And the basic idea is I'm going to sell you the right to buy my 100 shares from me. And we're going to agree on two things ahead of time. What you'll pay me and how long you have this option. I'm not going to give you this option and just say you can exercise it whenever you want for the rest of time, right? And so it might be, it could be any time, but say 4 weeks could be, very long period of time. And in terms of the price, most people that I talk to that sell covered calls sell them out of the money. Meaning, if the stock's trading at 161 bucks, they're going to what they call it, the strike price is going to be greater than that. So it's going to be, say, 170. Initially, covered calls can be very appealing because here's the idea. Let's say you set the strike price. So keep in mind what you'll get for selling it, because you'll get a premium. You'll get some income that you get to keep, whether the option's exercised or not. How much you'll get depends on a number of factors. How long the option's going to last for, right? Generally, the longer it lasts, the more you'll get. Of course, you're in exchange, you're giving up something for a longer period of time, right? The more out of the money, the less you'll get, right? So if I said to someone, I'm going to sell you a covered call on Apple shares, are trading at 160, it's going to last a month, and the strike price is $1,000. Well, they're thinking, that's probably not, it's hard to imagine Apple going above $1,000 a share in the next 4 weeks. Probably wouldn't get any takers, right? But, within some level of reason, and you can get on like Yahoo Finance and you can see all of the different strike prices. You can certainly sell one, that's in the money. I could sell a covered call on Apple that's got a strike price of 150, and that seems odd. It's like, wait a minute, Rob, you're giving someone the right to buy your $161 per share Apple stock for $150. Sure, if you pay me enough, right? Pay me $15 a share for that option, and I can add that to the 150 strike price, and I'm at 165. Yeah, why not, right? The problem with covered calls generally is to know whether you're going to get a good deal. You kind of have to have some opinion, I think, and a reasonable one, as to where the price is going to go, what the stock is going to do over generally short periods of time. Obviously, you can have longer term options, and it seems like a good deal. You say, well, I'll have the strike price 10% above its current price. Say it expires in a month, so at 160, I might have it at 176. Let's say. That'd be the strike price. And so the thought is I'll get the premium, whatever that is per share. Let's say it's $1 a share or whatever. And I get to keep that. And worst case, Apple reports earnings, I think it's tomorrow. I think. Let's just say they crush it and the stock goes to 180 and the shares get called away. Well, I still didn't do that poorly. I got the premium and I got this, 10% above where the stock was when I sold the option. The problem with that, though, is you gave away stock that's worth more, right? It didn't feel like a loss because you got all this money into your account, but you're worse off. You're less wealthy because you sold the covered call. And when I talk to folks that do a lot of options trading, they're not good at record keeping. I mean, they can have winners for a while where the shares don't get called away and they're keeping the premium, but they could have just even one, say, a year later, where the stock goes through the roof because of something, and the shares get called away, and all of their premiums for the past year get effectively wiped out with what they lost from that covered call. Anyway, it's kind of late for all of this. I got to be honest with you. I don't know. So back to this fund. I generally find you're better off just to buy, if you want the NASDAQ 100, just buy the NASDAQ 100. We can compare, like if we look at Portfolio Visualizer and we put in QYLD, right? That's what it was, if I remember correctly, 100%. I just want to see first how much data we have. Probably not much. Okay, 7-8 years. Now, this is on the NASDAQ 100, right? So, oops, here we go. We could just compare that to what? The QQQ, right? Oops, try it again. That's effectively the NASDAQ 100, right? Am I correct about that? I'm pretty sure I am. But I may be wrong. You can tell I don't invest in the QQQ. Yeah, I think I'm right. Okay. Yeah, it's close enough. So if we look at this, of course, I don't know. I may do this and maybe the QYLD crushes the QQQ. And in certain markets, it might actually, but it didn't. You can see here over this period. Again, this is just 7 years, so I get that. You did more than, look at that, 48,000 versus 20. And the funny thing is if you look at returns, let's just look at returns for a second. So red is the QQQ. Crushed it, beat it, beat it, crushed it, beat it, crushed it, crushed it, crushed it. But here's the interesting thing, and this is where you can get into income whether it's in this case from covered calls or from dividends, interest versus total return. So this is total return, right? This is sort of everything. But we can ask them to say, we can ask Portfolio Visualizer, if we're really nice and kind, to display the income, right? So if we analyze that with that again, I'm just so you see what I'm doing, I'm just checking this to yes, display income. Here are our returns right down here. We just looked at that. Look at the income. The covered calls are generating tons of income, far more than the QQQ. But tell me, I don't know, which one would you rather own over the last 8 years? The QQQ or the covered call ETF? Now, I'll be the first to admit, could there be exceptions, different time periods, maybe in a certain market? But I've just not found a reason to ever own a covered call ETF. So that's my take. And by the way, I'm happy if you guys push back and say, Rob, you're missing it. Here's what you're missing. By the way, if you look, let's see here. Yeah, one thing I will point out. No, that's wrong. Yeah, the standard, the QQQ is more volatile, but still, I mean, it's almost 22% compound annual growth rate versus 9. 16 standard deviation versus 10. I'll take that volatility for that return. Now, the QQQ is going to have some bad years. And I don't know, maybe in a down market, if we think about this, in a down market, I would expect the covered call ETF to outperform, right? Because you're selling these covered calls, the market's going down, so your shares aren't getting called away. My guess is Global X is probably selling covered calls at the money. Is my guess, meaning the strike price is the price that the stock is trading at when they sell it. I'm guessing. That's a guess. But if the market's going down, they're getting this premium, right? So they're getting that over and above the losses that both funds are getting from the QQQ or the NASDAQ 100. Anyway, there you go. That's my take. Take It in Stride says, my workplace 401k target date 2055 index fund through Fidelity is currently split 90-10, but 37.5% of the fund is an international EXUS, excluding US, index. Should I tilt more towards US equities? Well, we need to reframe the question. Your question is a good one. Let's first take a look at this. We can look at this in Morningstar. But I'll explain why I think we need to reframe the question. So this is a Fidelity. So Fidelity has, they call them freedom funds. They have both index versions of these target date funds and actively managed versions of these target date funds. And he said this was an index. So Fidelity target date 2055 index. Let's see if I can just search it that way. Not in Morningstar, I can't. Fidelity 2055 index target date fund. Here it is. It's well, I'll just show it to you at Fidelity. So yeah, it's got an expense ratio of 12 basis points. You see that right down here. And if we go to composition, you can see non-US, sure enough, 36.16. So I think you said 37.5, but close enough. There's some international bonds too. So should I tilt more towards US equities? Really, I think the question people often ask or mean when they ask that is, over some period of time, I guess between now and 2055 or through retirement, will I do better with less exposure to international stocks? I think that's really the question, right? I mean, if we knew the answer to that, we could answer your question. Should you tilt more towards US equities? Well, of course, we don't know the answer to that, right? So then we think, well, okay, we'll use history. And we can, and we do to some extent, but that gets tricky because first of all, we have to decide how much history are we going to use? Are we going to go back to the last 10 years, 20 years, 40 years? Some would say, well, it doesn't really matter. If you go back even up to 40 years, US stocks are going to outperform, right? So we could use that history to say, we don't want any international exposure. I mean, if we're going to use history, why not rely on history? And right. And but then you could even get more extreme. You say, well, wait a minute. If we're going to use history, why even bother with a 2055 fund? Let's just do small cap value. At which point someone probably said, okay, Rob, it's probably because it's late. Maybe you're tired. You are older after all, and it's probably close to your bedtime. I think you're losing it a little bit. I'm like, yeah, I'm probably losing it a lot of bit, but I get it. Someone would say, no, I get it, but that's just too extreme, and small cap value may not repeat itself. And okay, US stocks may not repeat themselves. So now where are we? And at this point, it's like, okay, how do we make a decision? We know we don't know the future. We all can agree to that. Although when you read the financial press, everyone that they write about thinks they do know the future, but we don't know the future. History can help us, but we can't rely entirely on it. And we certainly can't take history to some crazy extreme and put all of our money in whatever stock happened to outperform over the last 40 years, which actually might have been Philip Morris. I'm not sure. They were pretty good. They changed their name. Anyway, so how do we sort of balance all of this? And my approach has been to have about 30% in international. Now, it just felt right. I mean, honestly, I can't, I can use history to try to justify a certain position, but that's, there's only so much weight you can put on that. Again, for all the reasons, you got to pick the right history, the right length of time, the right mix of developed versus emerging, the right mix of US stocks. And then you have to hope that the future looks a lot like the past, or at least close. And so what I tried to do was just get to a level of diversification that I was comfortable with, that I felt like I could stick to it in the worst markets, whether they're the worst US markets, the worst international markets, the worst global markets. And for me, it was roughly 30% international. So back to your question, take it in stride. I don't personally view 37.5% as unreasonable, notwithstanding how international stocks have performed, certainly in the recent past. And in fact, for my stock portfolio, which I've now moved to, I've got it separated now from and this is all in my tax. Well, it's not all in my taxable account now that I think about it, but in my taxable account, I've got it all separated. I am looking at possibly investing in some index, some sector or country specific ETFs, and not as part of an asset allocation, because I view the portion that I've got set aside for stocks as not about asset allocation. And this is, the smaller part of our portfolio. The rest is asset allocation. But what I invest in here is not based on some X% of this and Y% of that. And I'm looking at things like emerging small cap value, which has a PE of like 7 right now. Frankly, small cap value in the US is pretty inexpensive. I'm looking at Japan, which seems crazy. I know, but they're cheap. Now, sometimes they're cheap for a reason. But when I look at how US has performed and international has performed, if someone said, okay, Rob, flip a coin, what do you think will do better over the next 10 years? I would guess international, actually. And I could be wrong. So yeah, I got that, right? Yeah, my hair is kind of a mess. I had a hat on all day. Anyway, that's my answer. Take it in stride. It's really, to me, it's more about how you think through it and what you're comfortable with than an answer. Rick, thanks for giving up your Monday, but really your Thursday stream is more than enough and appreciate it. Can't please them all. Well, appreciate that, Rick. But then again, there is no Monday Night Football. And the games yesterday, unbelievable. I mean, it's like the Bills, I want both the Bills and the Chiefs to advance. There should be some sort of special rule. I think we can pick one of the other teams that's still technically in the playoffs to boot them off the island and install the Bills into that. I mean, what a game. Unbelievable. That would have been a phenomenal Super Bowl. And I don't know, some might say it was the Super Bowl. Unbelievable game. Well, actually, the other one was amazing too. But what a game. All right, VJ, Rob and team, hello from Ann Arbor. Thanks for your latest video on Vanguard target date funds, capital gains issue. You are welcome. Kathy, do you have any experience with the Pralana, Pralana, retirement calculator. I do not, but let's look it up. I've never even heard of it. Here it is. I'll show it to you as soon as it actually comes up. I always like to make sure, I don't know what I'm typing into Google, and I don't want something coming up and having it show up on the screen. So, well, this is what I get right now. This is it. So I don't know. Oh, wait, there's more. Oh, it's a big X. No, it's a big V. I have no idea. It looks like their cascading style sheets may have not loaded. Let's try it again. That's CSS, by the way. Well, I don't know. Well, there it is. I will actually try to reload that at some point, Kathy, and check it out. What do we got here? Andrew. And by the way, I forgot to tell you this. If you want me to discuss a topic or you have a question for me, tag me in the comment because it shows up orange. And then I will do timestamps. I actually have someone that reached out and they helped me do the timestamps on the last one. In fact, I think I owe him an email, but he was terrific. His name is Matt, and I think he's going to help me do the timestamps going forward. I don't know if I didn't tell him that I was even doing a live stream tonight. I don't know if he's in the chat or not. Anyway, Andrew, can you discuss how robo-advisors, and he apparently uses Betterment, handle withdrawals in retirement? Betterment asks how much you want to take out, but hard to tell what strategy they are employing. Well, I'm not sure what you mean by strategy in the following sense. So the way Betterment works, we can bring it up on the screen if you're not familiar with it. Here it is. And I actually have an account, although it doesn't have any money in it. But the idea is you basically tell them your stock bond allocation. I want 90% in stocks, 10% in bonds or whatever. And then they take your money and distribute among a handful of ETFs, including Vanguard, and they use others, maybe BlackRock. I'm not actually sure. They tell you somewhere. And they have different portfolio options. They have an ESG option. And in the event, oh, here we go. Yeah, there's their core. I think they have ESG, social impact, they call it. Goldman Sachs Smart Beta. I don't know about that. Anyway, here's the Betterment core, and you can get all kinds of details. And then they rebalance for you. If it's in a taxable account, they have some automated tax loss harvesting tools that can generate some tax losses for you. You have to be careful with that because if you have Betterment plus your own, say, brokerage account that you're managing on your own, you got to be careful of wash sale issues. And here they talk about the different asset classes they have. But to your question, Andrew, if you go in and just say, okay, I'm retired, I want to take out 40 grand for 2022. My understanding is it just comes out of the account. They're going to take it out in a way that maintains your portfolio's allocations to each asset class, I think. Yeah. So, but I don't know if that's what you had in mind. I think that's how it works. Now, Betterment does have, let me just show you real quick. Betterment retirement withdrawal. I think they have some certain types of, they have things like how do I withdraw funds from my account? That's slightly different. They do have some tools for people in retirement, including they'll withhold your taxes on like an RMD and all of that. Here we go. Selling shares is a taxable event. Those sales could be triggered by a withdrawal or an allocation change. Tax impact preview, which I think is a feature they offer, shows the estimated gains losses the sales is expected to realize. And we can click on that link. And they walk through that tool. So that might be useful too. They say it's an industry first. So I don't know if that's helpful, but I think Betterment, for my money, Betterment to me is probably, Wealthfront's very good too, but they're the two of the best in my view, robo-advisors. The most features, reasonable cost. I guess you could get a little cheaper at Vanguard. I think their digital advisory services, I think it's 20 basis points, but they refund some of the fees. You could get as low as 15. But in terms of features, I think Betterment and Wealthfront are pretty good. I had accounts at both years ago. I had my SEP IRA at Wealthfront, regular account at Betterment, mainly just to test them out. But it's been years, and they've added a lot of features since I had accounts there. Oops. All right, next question. Rap Freak. I think Rap Freak has been in the house before. You often talked about getting an IRA account. By the way, so my wife, this may look funky, but it's not. My wife bought me this. Do you guys know what this is? It tells you basically how loud I'm being. Because I pointed out that my wife never listens to my videos, to which when I told her about that, she said, oh, I listen to them. They come through the wall. And then for Christmas, she got me this that measures the decibels. As I talk right now, I'm around 80. Is that loud? I don't know. Okay. You often talk about getting an IRA account as fat as a tick. Yeah, that was a saying my mom says every now and again. Like after we've had a big Thanksgiving meal, I feel as fat as a tick. And I thought, well, that's exactly what I want my Roths to look like. How does this factor into a 3-fund or a 6-fund portfolio? Put just your S&P 500 in there, mix in others, I assume no bonds. That's basically the idea. I tend to think of putting those asset classes that I think are the most likely to grow the most. And again, we're just sort of a guess, but certainly that would be stocks, not bonds. You might put, if you have exposure to small cap value, you might think of putting that in the Roth, but certainly an S&P 500. If you have a 3-fund portfolio, that would be fine. If you can. I mean, obviously it depends what your mix of accounts are and how much you have in each, what you can do. But that's the idea. And bonds, I would tend to, there can always be exceptions, but I would tend to put my bonds in a traditional retirement accounts. If I own bonds in a taxable, you could use municipal bonds depending on your tax bracket. Yeah, so that's kind of the idea. Aaron, Rob, what do you think about the little book that beats the market? I'll show it to you. And it's by Joel Greenblatt. Here it is. And I'll be honest with you, I've never read it. And I probably should. In fact, I'm going to probably buy it. Maybe I'll just buy it right now. As you can see, it's got a lot of reviews and it's got pretty good ratings. And I think it's probably worth reading. By the way, I should say, this is really for individual stock pickers, right? If you're doing a 3-fund portfolio, I mean, the book might be of interest to you. Well, actually, we can look and see what's on the inside. Let's go up to the table of contents. Oh, look at that. That's very informative. Chapter 1 through 13. Okay. Not helpful. Anyway, yeah, I've heard very good things about it, and I should read it, but I never have. I'll put it on my list. Yeah. He has a website, too. Isn't he the magic formula guy? Hang on. Let me pull this up. Magic formula investing. Is this Joel? I think it is. Yeah, here it is. Here's his website. 1990s called. They want their website back. There it is. But it's supposed to be pretty good. It's a stock screener. I've never used it. I'm not really into stock screeners, but maybe I should be. Zod says, hey, Rob, from Austin, Texas, finally a time slot I can join in. Well, good. Maybe you'll ask a question. I was in Austin not that long ago. Good food. All right. Philip. Rob, are you concerned at all about liquidity in an ETF during a major market sell-off? Before Vanguard's move, why did you prefer the mutual fund class? Well, so the Vanguard mutual funds, at least the ones I've invested in, are extremely tax efficient, at least so far. They always trade at NAV, so I don't have to worry about premiums or discounts. I'm just selling it. I'm buying it from Vanguard. I'm selling it to Vanguard. Just seems simple. I didn't have a need for an ETF. now I'm obviously rethinking that. Although again, I find it hard to believe they would do that to like their S&P 500, or if that would even be an issue. But in any event, that was sort of the thinking. Well, in a major market sell-off, I'm not selling. Right? I've never sold. I didn't sell during the Great Recession. I didn't sell during the tech bubble. I was investing then when it burst. I didn't sell with COVID. The only selling I did with the COVID-19 crash was some individual stocks for tax loss harvesting, and I went back in. Not the same investments, obviously, but in any event, so I don't sell during a down market. So that would never be a concern. Also, these kinds of funds, I mean, they're massive and they're actively traded. We're talking about Vanguard S&P 500 or Vanguard total stock market. So I'm not suggesting that there could never be a problem. I suppose there can always be some, well, kind of from what we just saw in the target date retirement fund. I mean, who knows what could happen, but kind of hard to imagine. But again, I don't sell during a down market anyway. So I don't worry about it. How do you protect yourself? So the market's been down. Today it ended up back up, right? We can look at it here. Up a little bit. All of my stocks. So the stocks I own are Apple, Berkshire B, Bank of America, Wells Fargo. They were all in the red. But the indexes were up. But if we look at say the last week, I mean, not pretty. Apple's been down a lot. It was in the 170s, and I guess it came back up a little. I have a good friend who's probably not listening, but his name is Joe. Love him to death. And one of the things I like about Joe is that he invests very differently than I do. We don't see eye to eye at all, and that's okay. And we debate this thing. So like he's all into selling the puts and trailing stop losses and all of these things to protect himself from a down market. And he's telling me how much he's made on his puts and whatever. And what are you doing, Rob? Well, I'm not doing anything. What would I do? I mean, I've got my plan. I don't have any debt. I'm just, living life. What do you guys do? What is there to do? I asked him. I said, you can buy puts. I think I may have said sell, but he buys puts, right? You buy them to protect from the downside. But I was telling him, there's a cost to that. They're not free. Why spend the money? And if you do it, I get the appeal to a trailing stop loss. Well, I can never lose more than whatever, 5%. But once you trigger the sale, and let's even put aside taxes, so maybe it's a retirement account. Now what are you going to do when you get back in? And he said to me the other day, he said, well, wouldn't you have loved to have avoided the tech bubble and the Great Recession and all that? And I'm like, yeah, I'd love to have been able to sell at the top and then buy back at the bottom. If you know how I can do that, let me know. I'm all in. But I don't know how to do that. And then he sent me an article from Stansberry Research, which is, from what I can tell, a company that basically preaches gloom and doom 24/7, 360. I've yet to read anything from them that doesn't say the biggest crash in the world is coming. And eventually they're going to be right. They're right every couple of years. All right. Ellie says, from Philly. All right. I was a 76ers fan as a kid. I don't know why. I grew up in Ohio, but I just loved Dr. J. I remember one day I was playing basketball with our son, he was very young, and he did some sort of wild move. I said, man, you look like Dr. J. And he's like, who? And immediately it was into the house. We're pulling up YouTube. You're going to learn, you're going to meet Dr. J. Anyway, how high do you think the Fed would have to raise interest rates to deal with current inflation? And how worried should we be about a recession? Well, in terms of interest rates, there's no way to know. So they're going to do a couple of things, right? They're going to stop buying bonds. That's really the first thing, or they've already started to slow down. And eventually they could sell bonds into the market, right? And they can raise rates. And they're clearly going to raise rates. I think at least that's the conventional wisdom, and I have no reason to doubt that. So they're going to raise rates. But how much is really, I mean, there are predictions, and the market has predictions, but there's no way to know because we don't really know what inflation is going to do. You might have an opinion. I guess there's a lot of opinions out there, but we don't know. So it's, I don't really think you can predict that. Still getting over my cough. I do feel better. And I don't have anything as I keep coughing. They did all the tests. They're like, you're normal, or at least as normal as you're ever going to get. All right. How worried should we be about a recession? Well, I'm not worried at all, but that's not really much of an answer. Maybe another way to look at it is, how likely is a recession? I mean, we're definitely going to have a recession, right? We just don't know when. I don't really, it doesn't seem to me though, like recession is our concern right now. I mean, there's pent-up demand, supply has been bottlenecked, wages are going up. I'm not, at the moment, I don't see a recession in the next year. But I'm not like making investment choices based on that prediction, right? But I don't really see a recession coming, at least in the near term. I mean, there'll always be recessions, right? At least until the sun burns out. We got that to look forward to. Okay, Danny, can you cover self-insuring for long-term care through your investment? Dave Ramsey said there is no data beyond 5 years, and the average is 16 months. I'm getting a notice. Hang on for a second. Bear with me. I just want to make sure the notice has nothing to do with this broadcast. It does not. Okay. Well, I don't know what Dave is talking about, or, I mean, first of all, you absolutely can insure long-term care through your own investments. So the problem with long-term care insurance is expensive, right? And its coverage is limited. You can make it less expensive based on saying how long you're going to go needing long-term care before you actually trigger the insurance. You go 1 month, you go 6 months. Obviously, the longer you go, the cheaper it gets. But the coverage is limited, and that may be what he means by the average is 16 months. Well, maybe by that it means the average need for long-term care is 16 months. And that sounds about right to me, but I couldn't put my finger on data, a study right now. But I mean, I looked at long-term care insurance, and I think I did a video about it at one point. What I found was that you certainly can self-insure depending on your finances. If you don't have much money at all, Medicaid's going to kick in, and Medicare in very limited circumstances, but Medicaid's going to kick in. If you've got a lot of money, and I don't know what a lot is, I'll say 2 or 3 million or more, you probably can self-insure. Certainly if you get significantly above that. The insurance probably not going to do a lot, or not going to be a big need for it. It's the folks in the middle, right? They're not at the bottom, and they're not way up at the top. They're in the middle, and it's tricky. And so I would suggest you talk to a financial advisor who's not going to sell you long-term care insurance and let them run the numbers for you. And it's probably not a very satisfying answer, but I really have come to the conclusion that long-term care insurance for a lot of people is not necessary. But there's exceptions, obviously. Yeah, I don't know how helpful that is. I know I've talked about this in the past. I did a bunch of research. Let me just see real quick in the YouTube channel. I don't remember if I did a video when I talked about it, or if I just covered it in a previous live Q&A. Long-term care. I'm searching my own YouTube channel. Yeah, must have been in a live Q&A. Displaced Hoosier, welcome back. Had this same issue with VTTHX and sold out before the distribution date to avoid the tax. Yeah, but you would have incurred the capital gains from selling it, right? But okay. Interested in how you transfer mutual funds to ETFs without any tax implications. Well, if you've got Vanguard mutual funds, you want to convert them to the ETFs, you can just call Vanguard, right? How they do it and not trigger taxes, like the behind the scenes, I don't know. No idea. But I know, as I mentioned in the video today, the website, they make it clear you can do it. I haven't pulled the trigger on that. It's not like my hair's on fire, so to speak, to get out of these Vanguard mutual funds, but I probably will. I don't know. I'm a little nervous about leaving the capital gains distribution decision to a mutual fund company when I don't have to. Oh, here's Mark's an interesting comment from Mark. Vanguard has taken low-cost investing too far. They seem to be too focused on costs and not enough on infrastructure, technical, and human. Someone should have thought of the consequences. I've heard that from a number of people, actually. And that's why, like, Fidelity can invest $2.5 billion a year in technology. Vanguard, I think, is at $1 billion. Still seems like a lot of money to me, but what do I know? But yeah, it's interesting. I mean, I'm not, I don't know. Today was not my favorite day for Vanguard. I mean, I'm still a huge fan. Don't get me wrong, but I have the same. I will say, Mark, I have the same concerns. And you can own their funds and not be on their platform, by the way, as well, right? Oleg says, could you please speak about alternative minimum tax, AMT? I'm wondering how exercising stock options could affect taxes. Well, yeah, I mean, whether it's going to trigger alternative minimum tax is going to depend on a number of factors, but your overall tax situation. So what I would suggest, there's really no way for me to answer that question in an abstract way. I would suggest, you just talk to a tax professional and give them your numbers. It's okay if I exercise these options, what the tax consequence is going to be. I will show you a neat tool. It's expensive though. I have not used it, but I plan to. And I don't know, it might help you, Oleg. I don't know. It's got a weird name, I think. It's called HolistiPlan. When I first heard it, I thought, well, this is some sort of medical insurance, holistic medical. Yeah, no, here it is. So this tool is really designed for tax professionals. And it's HolistiPlan.com, and it's not cheap. The least expensive plan is $450, and it gives you 30 uploads per year. And you're thinking 30 uploads of what? By the way, there's a 7-day free trial, which I'm going to try out here soon. What you can do is upload a PDF of your tax return, and it uses optical character recognition, OCR, to suck in all of the data from the PDF. And then it allows you to create sort of hypothetical scenarios for future tax years while indicating changes, like a Roth conversion, for example. And it will show you the tax consequences. So like it could take your 2020 return. Well, let's say you filed your 2021 return. It could take that, and then it could take the data, move it into 2022, and then you could make change in some of the numbers. You say, okay, we'll assume the data is the same, but we're going to do a Roth conversion, and it'll show you the tax consequences, which can go far beyond just your tax bracket, right? It can impact Affordable Care Act. It can impact if you're getting Social Security, taxes on your Social Security. It can impact your IRMA, your premiums for Medicare if you're at that age. So a lot of different things. And there's actually a video right here on their site. So you can check that out. I don't know how it would help, Oleg, with your specific question. Maybe it wouldn't. And it may just be that you want to talk to a tax professional. That's what I would recommend. You can do, if you want to get like, you can get, like if you go to the IRS, you can just Google topic number 556, alternative minimum tax. And it walks through how it's calculated. Am I subject to it? One of the things about AMT is that it's not indexed for inflation. By the way, the 3.8% Affordable Care Act tax is not either. So it's going to catch more and more and more folks. Vinyl asks, and I say Vinyl, that's his short nickname. It's really Vinyl One Earth Link. If you have no other income, dividends and capital gains are tax-free for a couple up to nearly 100 grand. Yeah, that's true. You get the reason it's nearly 100. It's actually a little more than that. It's because you get your standard deduction. But that is true. And I'll show you. We've seen this before. This is NerdWallet, whatever. And you can get this information anywhere. Here's 2022. Married filing jointly, 0% bracket. Now, if you have no other income, because remember, ordinary income will push this number. It sort of fills it up. Ordinary income fills up that zero, even though that's for capital gains. Your capital gains will sit on top of any ordinary income. So if you have, $83,350 in ordinary income, which was the limit for the 0% on capital gains, the tax rate for married couples, any capital gains will sit on top of that, and you'd be taxed at the 15% rate up to $517,000. Hope that makes sense. But the reason he says 100,000, this says 83,350. You got to remember, for married couple, you get, what is the standard deduction? I don't even know now. It's 24,000, right? But deduction, let's say for 2021, 25,100. All right. And for 2022, I don't know what it's going to. It's going up. It's going up to something. Does it really matter? It'll matter eventually. I can't find the number. Who cares? VJ says he was introduced to auto investing 10 years ago by a relative into PRDMX. No idea. Oh, it's T. Rowe Price dividend mid-cap growth. Okay. Last week opened M1 account and moved my auto invest. All right. Wondering how M1 makes money. Is it going to survive? Well, they make money a couple different ways. But we can Google it. You can Google anything. And here it is. This is from H1 itself. H1. M1. Interest on cash, right? Interest on lending, because they lend, right? M1 borrow, more lending. Interchange fees, right? Because they have their M1 Visa debit card. Payment for order flow. That was the whole thing that got everyone up in arms over Robinhood. Oh, and they have M1 Plus, which has a membership fee. There you go. Whether they're going to survive, I don't know. I can tell you as a YouTuber, it seems so weird to describe myself as that, but I guess it's a fair, apt description. I get all kinds. I mentioned I got someone wanted me to promote their bidets on the channel. I don't know. Maybe. I got another one for electric toothbrush, which I love. I have a Philips Sonic. I like it. I don't remember which electric toothbrush they emailed me about because I hit delete. But I get a ton of emails from stock trading platforms. Like, what's the one? Is it Moo? I don't know. I just refuse to put my money in a company called Moo. Could be the best platform ever. Yeah, they keep emailing me. I've never responded. They want me to promote their platform. So anyway, VJ, I don't know if they're going to survive. I don't know. I mean, I don't have any reason to think they're not, but I mean, eventually, it's interesting. All of these sort of tech companies, from the Robo-Advisors, the Robinhoods, the M1, they've all come, I guess, were founded and have grown up in a rising market. All right. I mean, I remember when I mentioned this, I met John Stein when Betterment was practically first launched. And I want to say it was 2011. And the market's been up almost every year, and significantly. And that's good for these companies for obvious reasons. But it'll be interesting to see if we have 2 or 3 years in a row that are down double digits. Who's left standing? Some companies, I don't know if they'll merge. I don't know. Something will give. Don't you think? I don't know. Dave, do I pay taxes less often on an index fund that only pays dividends gains once a year in December, as opposed to 2 or 4 times per year, assuming no other dividends? This almost seems like a trick. It's like a question from the bar exam. Well, as far as I know, most funds pay dividends 4 times a year. In my experience, they pay more in December And in fact, we can look at this. Well, I don't have to guess. Let's just we'll pull up VTI. This is an index fund. Vanguard's total stock market. Here, I'll show you where we are. We're going to go to performance. Remember, we're going to go to distributions. Boom. Yeah. So so it didn't pay any capital gains. But if you look at the income, it paid income in March, June, September, December, right? So 4 times. I think of course, you're going to file your tax returns once, obviously, and if you owe anything at that time, you'll pay it. I guess the question maybe you're asking is, could these quarterly payments trigger the need to pay estimated income tax? I think that might be your question, Dave. And if I've got it wrong, let me know. And the answer is, it could. I mean, like if you had a lot of money in one of these, not paying the estimated taxes, if it was enough, could in theory trigger penalties, right? I've never thought about that. I pay estimated income tax, but it's because of my business. I've never thought about the need to do it based on dividends that I get. Although, as I think about it, my accountant, when he calculates my estimated taxes, would account for the dividends. So maybe they do. It's just we don't talk about them as some sort of separate item. So I don't know if that answers your question, but yeah, I mean, it's income and it gets paid. Obviously, we're assuming a taxable account. It gets paid quarterly, and it could be enough where you'd want to pay estimated taxes, right? It's possible. Depends how much you have. If you only got if you got a distribution only in December, and this is where I'm just not a tax expert, certainly not at this kind of level. It may be that you would want to make a January 15 estimated payment for the prior year. But I would talk to a tax pro just to make sure and have them calculated if need be. Adam wants to know my thoughts on an employee stock purchase program. Well, my only experience was when I worked at KPMG Consulting, which spun off of KPMG. I was in-house counsel, and they renamed themselves Bearing Point. They were a publicly traded company, and I did participate. And I think it was a 15% discount. And basically, we had certain windows when we could sell, and as soon as that window opened, sell. I'm like, got my mouse. I'm ready. It's hovering over the sell button. I'm watching the clock. That was my own personal assessment of the company. But I got the 15% discount, so it was pretty good. I liked it. You always have to think about diversification and how much you have. Are you getting options? What's that going to look like, or some sort of restricted stock units or something? And you kind of want to look at your overall portfolio. But my view was, I'm pretty sure it was a 15% discount. This was nearly 20 years ago. But I think, it was like I get a 15%, thing. I got to pay taxes, but 15% is not bad. So Mike says, QYLD, remember that's our covered call ETF, does sell covered calls against the index fund, which is a European style option. So you're already eclipsing my knowledge of options trading, and can only be exercised at expiration date. Okay. And there's some good arguments why you would only want to do that anyway. But in any event, fair enough. Hence, some stability against being called away quickly. All right. But the issue is the same, right? They're going to get exercised if the price has gone above the strike price. So, but yeah, that's good to know. Thank you. Matt says, if you roll over a Roth 401k, all right, which I just did, I use Capitalize. I actually talked to the founder of Capitalize today. I can tell you about that. If you roll over a Roth 401k into a Roth IRA, is the entire rollover considered basis? Oh, this is a good question. For tax penalty-free withdrawals if you meet the 5-year rule for the Roth IRA? I don't think so. And I'm going to give you a lot of caveats here. You need to confirm this. I could be wrong. That should be a given for everything I say. This is the envelope that Capitalized sent me. It's addressed paid, going to my broker with my two checks, because I had a Roth 401k like you do, Matt, but there was also matching contributions. Those go to a traditional, and let's see here. Is this the one? Yeah. What I can tell you is for the Roth, I need to mail this. I should have mailed it last week. Here it is. It separates out. My contributions to the Roth and its total value. And so I do think they distinguish that. It's based on a very scientific analysis based on a check stub from my 401k. But it also makes sense to me. Not that the tax code always makes sense. So I don't think they treat the whole thing as, I think they separate out what you contributed versus gains, I think. And maybe someone in the chat smarter than I can either confirm that or say, Rob, you don't know what you're talking about. And that's okay. By the way, so Capitalized, they were great. There were some issues. And I emailed my contact there and I told them what they were. It had to do with, so I have a Roth, and because there was employee contributions, I had a traditional. And when they sent the instructions over, the instructions reflected that it was just a traditional. Well, I knew that wasn't the case, and I could fix it. It wasn't that hard. But I emailed them to let them know. And the founder got back to me. He wanted to talk. So I got on the phone with like six folks from Capitalized. They were great. And he explained what happened. The details aren't all that important. Normally what they do is have a phone call with you. So Capitalized is a free service that helps you roll over a 401k to an IRA. Normally they have a phone call and they walk you through everything. They make sure they understand what 401k accounts you have. Because of the time of year and the volume, when I did my rollover, they gave me the option to do it myself with step-by-step instructions, which were actually quite good. But I think because I wasn't on the phone call with them, there was some mix-up with the type of accounts that I have. Normally, though, the normal process is you're going to have a phone call with them within a couple of days after you sign up and initiate, do all the things you need to do to sort of get the process rolling. But they were great. I would use them again. I just don't have any more 401ks. So there you go. So Brandon asked a question. He did not tag me, but I see the question, so I'm going to do my best to answer. But remember, tag me if you want me to see your question. Do you recommend moving some free cash to physical gold and silver? Inflation continues to go up, and I don't see the Fed doing anything to get in front of it. Well, I do think the Fed is doing something to get in front of it, but that doesn't mean we won't have runaway inflation. I'm not convinced that gold and silver are great hedges to inflation. I think long-term, stocks are probably the best hedge, long-term. And I'm not a fan of gold and silver because they're not productive assets. They don't do anything. They just sit there. So if I were going to sort of hedge against inflation, equities would be a big part of that, which they're a big part of my portfolio anyway. And I would look to I bonds and tips. I probably wouldn't look to gold and silver. That's just my own preference. I know that there are others that disagree, and it's okay. They can be wrong. No, I'm just kidding. Well, I'm not, but maybe a little. I know Dalio was big. His all-weather, was it him? Was he the all-weather portfolio? Yeah, I think he had a big allocation to gold and whatnot. And you can, over the right time periods, his portfolio did very well. Had long-term bonds. Anyway, gold and silver is just not a productive asset. You buy it and you just hope you can sell it for more. And no, I don't view stocks that way. I mean, some would say, well, haven't you just described stocks? No, I don't think so. In any event, so that's my take, Brandon. I just think equities long-term, short-term, they can be a mess. But long-term, they're a pretty good hedge on inflation. And unlike the 70s and 80s, those of you old enough to remember those decades, we have tips. We didn't have them back then. We have I bonds. That's my thinking. I enjoy gold and silver, like the thought of them, and maybe investing in some American Eagles. I don't own any right now. That's not to say I never will, but will it be a significant or meaningful allocation to my portfolio? No, neither will crypto. I own a few, very tiny amounts. They're great for losses. but it's insignificant. And I could see buying some gold or silver down the road, but never, my thinking would never be, I'm going to buy enough so that I can hedge inflation. It would be, boy, these American Eagles are cool. Let's get a couple. Vinyl says, I could never get covered calls to work, even when I bought the stock for the sole purpose of selling calls. I hear you. Daniel, welcome. Southern Australia? All right. Fast Eddie, welcome back. My wife will have stock options available in March or April. What are the tax problems I could run into if I sell or hold? I have no idea. I really don't. And my hunch is there's not one answer to that. It might depend on the particulars of the stock options. So, I wish I could give you an answer, Fast Eddie. I can't. Not any meaningful answer. I've never had stock options. That's not true. I had some that didn't vest, and then I quit. Gage, may you please explain what cost basis entails? Well, you can think. So let's start with an easy one. Berkshire Hathaway. Why is it easy? It doesn't pay dividends. So let's say you spend $100 and you buy some Berkshire. That would be a fractional share. That's your cost basis, $100. And if it goes up in value and you sell it later, let's say you sell the whole thing. Anything above the $100 that you get when you sell would be considered capital gains. Short term, if you held the stock for less than a year, long term, if you held it for more than a year. But your basis is effectively what you paid for the investment, right? Now, it gets a little difficult, or not difficult, it gets a little more complicated when, let's say you invest, we'll say an S&P 500 index fund now, and it pays a dividend. And you take that dividend and just have it automatically reinvested in the fund. So that means every quarter, in addition to any new contributions you might make, which are all getting made at different prices over time, you now have these dividends that are getting reinvested, all of which affect your basis, right? And so trying to track all those numbers can be overwhelming. The good news is your brokers do it for you. I can log into my broker's account and say, okay, for this investment, whatever, what's my unrealized gains right now? And they'll tell me, here are your short-term gains, if I have any, here are your long-term gains. And then you can just do the math to figure out what the tax consequences would be. What do I mean by that? Let's just say, we'll make it a round number. You got $1 million. That's your value in some stock or ETF, whatever. You got $1 million. And when you look at your unrealized gains, as shown to you by your broker, it says that it's 400,000. Okay, so that means that 60% of that 1 million is basis, 40% is unrealized gains. So if you sell, let's say you sell 100 grand, 60,000 of that 100 grand should be basis, if I'm not mixing up my numbers, and 40,000 of that would be either short or long-term capital gains, depending on how long you held the investment. Now, there are different ways to do. I always use sort of just an average approach to calculating basis. It can get more complicated because you can look at, you can identify a specific purchase you made in the past and say, I want to sell the shares associated with that specific purchase. Okay, but you're still going to have the same, okay, what was my basis? What are the unrealized gains? And hope that helps. And I hope I didn't get it wrong. Pretty sure that's more or less right. Conscience asks, VTV or SCHD for LCV exposure? There are way too many TLAs in that, 3-letter acronyms. LCV, large cap value? I guess that's probably what it means. Well, we know SCHD, that's Schwab, right? VTV, I'm guessing, is a Vanguard ETF. Let's find out. Oops, here we go. Vanguard Value ETF. We have a winner. So there's the Vanguard Value ETF. And you want to compare that, let me pull up another version of Morningstar with SCHD, which is Schwab's dividend fund, right? There it is. Wait, there it is. I'm going to pull this down. I'm going to move it over No. There we go. So here they are. So you don't say whether this is a taxable account, but given the issues with Vanguard's target date funds, let's first deal with that. We're going to go to portfolio. Not portfolio, excuse me. We're going to go to performance. Because I have this on half a screen, it's giving me the mobile version, which is fine. And let's see, we'll go down and look at this. So you can see just from the color codes, the only thing it's distributing is income, which is good. So that'd be dividends, right? Up to $3. What's the NAV on this thing? Hang on, let me make this bigger. That's $146. See right here. So okay, so that's that's typical. It's a value fund is going to have a higher dividend yield than like the S&P 500, I would think. Yeah, it's around 215. S&P is around 120. But in any event, so that's pretty good on the taxes. Let me make this bigger. Performance. Now let's look at Schwab. Just make sure. Yeah, I mean it's an ETF, so you wouldn't expect any gains to be distributed, and it's got income. Again, you would expect that. Not as much, right? You notice this. I don't mean that in absolute terms, although that's true as well. But it's smaller. Smaller number here. I'm thinking the yield here is a little lower. Maybe it's not. No, it's not. I'm wrong. My bad. It's 278. Okay. So they're fine on taxes. Again, it's an ETF, so you'd expect that. So now let's compare the portfolios. Come on, internet. Let's work. They're obviously, well, not obviously, but they're U.S. equities. We see that here and here, right? And we can look at the style map. So they're pretty close. This one's tilted. This one is Schwab. It's tilted a tad bit more to value, a little bit, and it's a tiny bit smaller. We can actually go to the weights and see how it's distributed. So this one it's a little smaller, right? It's got a little bit of small cap, a little bit. It's actually got a little less mid cap, but they're still very similar. And we can come down here and look at their valuation metrics. I would think they would be comparable. Yeah, Schwab's a little cheaper on a PE basis, but a little more expensive on price to book. Price to sales, it's a tad more expensive. Same thing with price to cash flow. But generally speaking, they're comparable. You can look at sectors. I want to go down and look at their top 10 holdings. One thing to note. Let's see here. Vanguard has 355 equities. This one has 101. I mean, I don't know that I would put much weight on that, but it's an interesting. This is a more focused portfolio, and their top 10. There's some overlap, but not much actually. We can look at performance. I'll tell you which fund I probably would pick, but I mean, I almost hesitate to do that because it's like, well, who cares, Rob? I mean, both of these funds would serve similar purposes, but I'll still tell you in a minute anyway. I just wanted to look at returns, and we'll look at, we'll come here and look at, is that all they have? Oh, here we go. So the 10-year return on the Schwab fund is 12.93. And what just happened? Did I lose? Whoops, let me try it this way. There we go. And this is getting out of hand. I think I was looking at Vanguard. I'm looking at Vanguard. The 10-year was 12.93. And for Schwab, the 10-year was 14.65. Again, I don't know how much weight you'd put on that. I kind of like the Schwab fund between the two, but if you ask me to articulate why, I'm not sure I could. They're both comparable. They're both good options, but I'd probably pick Schwab. Why? I don't know. You got to pick one of them, right? R asks, does what happened with Vanguard also happen with other funds, say Fidelity? I've not seen it happen with other funds. Not the set of circumstances that triggered the capital gains in 2021. It may have, and I just didn't know about it, but I've not seen that before. this is Gage, how do you feel about Alibaba as a long-term value stock? Well, it's interesting because that came up on my radar. And I forget why. They're like the the Amazon of China, right? Here's the stock in Morningstar. Let's look at key ratios. I mean, the one thing about this, and this is just the reality, is you're going to have to deal with, the political issues surrounding this company. And that's very hard to predict. And that would be my first big concern. I've not done a deep dive on it, but I know that there are many people looking at this particular stock as a possible value. Although it's interesting that Morningstar has it as a core, not a value. I was looking full key ratios data. Let's see what we get. Oh my, look at this. This is old school. This is how Morningstar this is what they used to look like. This is when they had tons of data. This gives you more data than the other one. I will tell you, as a general rule, I'm more comfortable with stocks that pay a dividend, which may sound odd because you say, well, Rob, haven't you said in the past that dividends don't make you wealthier? That's true, they don't. Reinvesting them, of course, is a smart move. But I tend to invest in companies that have a lot of history, and as a result, tend to have been around long enough to pay out a dividend. I wanted to see. Yeah, I just have to do a deep dive. It's hard for me to do that in such, you'd have to do a lot of analysis of this company. And I probably won't, meaning I probably would pass on this just because there are too many unknowns for me, which, by the way, is how I view most stocks. If someone said, what about a Tesla? Like, yeah, I don't know how to value it. There's too many uncertainties. Could be worth a fortune. I don't know. Hi, Rob. We have a considerable number of UNH shares vesting next month. I don't know what UNH is. United Healthcare? What's UNH? Whoops. I hit some weird button on Morningstar, and this is what it looks like. It's like, I think I've hacked into Morningstar, or not. Yeah, United Health Group. Okay. Shall we keep them or invest in something like VSKAX, which is their Fidelity's it's total stock market, right? FSKAX. Yeah. Well, so the question with regard to single stock exposure, I always think the safe thing to do is to get it into a diversified portfolio. Again, putting aside from them tax issues. That's the safe thing to do. However, as you know, I own a number of stocks, 4 of them, and one of them, Apple, is probably 15 to 20% of our overall exposure, which is contrary to what I just said. But it's one of those things that I've owned for a very long time. It's grown. Well, actually, it's probably smaller now. The stock has been down, but it's just grown over the years. And I'm comfortable with the company. I don't have any reason to believe I should sell based on company performance. But I am taking risk. And if you say considerable number of United Health UNH shares, so if it's a significant part of your wealth, you just have to recognize that as big and seemingly stable a company as it is, you're taking a lot of single stock exposure. Now, the hard part is, you sell it, you put it into an index fund, and it clobbers the market over the next 10 years. And you're like, who was that stupid guy on YouTube I was listening to? What was his name? I can't predict the future. So you part of it is deciding what you're comfortable with. And what would happen if it lost 50% while the market didn't lose anything? What would that do to your finances? That's why I cringe when people became crypto rich, seriously rich, and they still have everything in crypto. I'm like, are you kidding me? You've hit a home run. Trot around the bases. Sell some to cash. So that probably all sounds like happy talk and a non-answer. I don't know how to answer that for you. Generally, I would say the smart thing is to diversify. Even though, at least in the case of Apple, I've not done that. And who knows? I might end up regretting it. They were down today. How are we doing on time? 8:25. Okay. VJ says international stocks are very cheap now. We should increase the percentage of international. Well, there's certainly an argument for that. Okay, Paul. I don't think I've ever answered a question from Paul. Maybe I have. Man, I'm looking at all the questions I've got to get to. I'm way behind. What are the advantages, disadvantages to holding a mutual fund versus its equivalent ETF? Well, I mean, that's sort of a timely question. Why do they have different expense ratios, minus the new risk you've already discussed today? Well, I mean, I don't know that I can answer as a general rule why they sometimes have lower expense ratios. They don't always have, sometimes the expense ratios are the same. Sometimes there are 1 or 2 basis points different, for these low cost index funds. And I don't honestly know why that is. I assume it's cheaper for, it may be because with the mutual fund company, there's additional overhead because you're always buying and selling from the mutual fund company. Whereas with an ETF, you're buying and selling with other investors. So maybe there could be extra overhead for the mutual fund company with mutual funds. I'm assuming that something along those lines. But beyond that, taxes are probably the single biggest issue. Some people own ETFs because you can get into options and all this other stuff. As you probably figured out by now, I don't do that. The other one benefit to ETFs is you can own them pretty much anywhere without fees. You can buy and sell Vanguard ETFs or Fidelity or whatever on just about any platform, and they're free. There's no fees. If you want to buy a Vanguard mutual fund, say at Fidelity or Schwab, or pretty much anywhere, there might be some that are free, but many of them you pay a fee. So just having the ETF can be more convenient. Now, if you're at Vanguard, they're pretty much identical. I mean, again, other than that hairy tax issue that we just encountered this year with the target date retirement funds. So there you go. Michelle, 35, debt-free, full-time student, no current active retirement account to contribute. How to invest $15,000 so that this money grows maximally over the next 30 years. 3-fund portfolio. Well, I can guarantee you that if you invest that money in a 3-fund portfolio, there will be some other approach to investing that will outperform that 3-fund portfolio over the next 30 years. I guarantee it. The odds that a 3-fund portfolio, let's say 60% total US market, 30% international, 10% some kind of bond fund, I could all but guarantee that something else will outperform that fund over the next 30 years. I can also guarantee you that there'll be plenty of approaches to investing that will underperform over the next 30 years. And in fact, I suspect there'll be far more approaches to investing that underperform than those that beat the performance. I can't guarantee that. That's just a guess. That's what I believe. Here's the problem. There's no way to know what approaches to investing will outperform. I think there will be some that will. Maybe it's 100% S&P 500. I don't know. Maybe it's more international. Maybe it's a healthy dose of small cap value. I don't know. I do believe that 3-fund portfolio will do well. Will it be the best performer? Not a chance. Will it be the worst performer? I seriously doubt it. And you might say, wait a minute, I gave up my Monday night to ask Rob a question like this, and that's what I get. It's a really important answer. If you hear someone answer your question with complete confidence that they're right and here's what's going to happen, run, because they don't know what they're talking about. So I think a 3-fund portfolio is sort of the core starting point. I think it's a good portfolio. There's no doubt that other approaches will outperform it. I don't know, you can pick a single stock that will outperform it, probably. I just don't know what that stock is. In fact, the company that outperforms the 3-fund portfolio over the next 30 years might not even exist yet. I have a little fun with this, but I hope you see sort of at least my approach to this. You got what can we know? What can we control? What don't we know for certain? What can't we control? I think a 3-fund portfolio is a good way to go. But you got to understand all those caveats. Scott has an off-topic question. You mentioned your interest in reading presidential biographies. Yes, not today I didn't, but in the past live Q&As. In fact, here's the one I'm working on. You know what I learned about John Quincy Adams? So in the current debates in Congress, the Democrats are unhappy with Joe Manchin and someone else, I forget, because they're holding up the Build Back Better plan, maybe getting rid of the filibuster so they can get voting rights legislation passed. I'm not here to discuss the merits of any of that. I think both parties need more Joe Manchins. More people who they feel strongly about what they believe, whether it's the Democratic view, Republican view, that's great. But they just don't vote the party line. And that's John Quincy Adams. He was the first Joe Manchin. Yeah. In fact, he started out as a Federalist. That's what Washington was. John Adams. Jefferson was not. He was a Republican. He was very much into individual and state rights. And John Quincy ended up leaving the Federalist Party. But he decided what he thought was right. And whether his party or either party was in line, it didn't concern him. Anyway, that wasn't your question. The most underrated presidents are James Polk. I have a biography of his, and he must be underrated because it's only about this thick. And Calvin Coolidge. I haven't bought a biography yet of President Coolidge. Great historical read, Meet at Gettysburg. All right, good. I'm really looking forward. Robert Caro, do you know who he is? He wrote, I think it's now 4 volumes. I've got them in my library, which is right through that door. They're like, if you stack them up, they're like this tall, and they're all of Lyndon Johnson. It'll take me a year to read them. I can't wait to get to them. Anyway. All right, what do we got next? Well, Mr. Dan32 has a very important question. How could Tampa Bay blitz on that last play against the Rams and leave Cooper Kupp, wide open? I don't know. I don't know what to tell you. They were both great games. Akeem, what do you think about the book Stock Traders Almanac 2022? I've never heard of it. Let's take a look-see. There it is. I don't know. It's a #1 bestseller. Let's look inside. Well, the 2022 outlook, that always gives me concern. A strategy calendar, that gives me concern. January's first 5 days, an early warning system, that gives me concern. I always love, the stock market's down now, or it was, last few days. Like Jim Cramer, I find him entertaining, and he does report on some news. But I mean, at one point he said, investors should sell any stocks they own of companies that don't make any money. Thinking, really? I can't argue with that. Anyway, they take a couple of days and then they want to project what this means. They don't know what it means. Now, in fairness to someone like Jim Cramer, I can't imagine having to try to say something smart about the market every single day. I don't know. I would be terrible on one of those shows. So, Rob, what do you think? What do I think about the stock market? Why did it go up today? Oh, yeah. I don't know. You want to play some chess? Okay. Yeah. So I don't know. Maybe it's interesting. I'll have to check it out. I don't know. That book is new to me. Thank you for bringing it to my attention. It could be great. I don't know. It strikes me as sort of a technical analysis kind of thing, and that's not my approach to investing, but I could be wrong. David, I have no idea as to what the price range is on what I should pay for an advisor. Never have invested in market before. I'm retired. Thanks, David. Well, so the industry standard is like 1%, but I think that's highway robbery. If you want help, I would try to find help for 50 basis points or less. That's what I would be looking for. Vanguard is 30 basis points. The downside is everything's going to be by phone. You're never going to meet with Vanguard in person. At least I don't think. You can get help where someone will help you set up a portfolio, tell you exactly what to invest in, but you actually go do it. And they're not charging you a percentage of assets under management. You can talk to them once a year or whatever. That's one way Mark Zorro works. I think Rick Ferry has some services like that. When the market drops and you need someone to talk to, you can call them up, schedule an appointment. So that's an option. The problem is, the problem is that 1% is just a lot of money. Can you? I mean, what service could you possibly get from someone where you're willing to give them 1% a year of your investable wealth? I can't think. I would think people were insane if they came and said, "Okay, I'll do whatever, and you give me 1% of your investable wealth every year." Plus, by the way, the costs of whatever I decide to invest your money in. That the 1% doesn't cover that. It just is crazy to me. Yeah, that's my thinking. So I think 50 basis points might be a good attempt to try to find something in that range if you actually wanted someone to take it over. Yeah. Remember to tag me if you have a question, but I see a question that I wasn't tagged in, but that's okay. Paula. Rob, have you ever heard of the HedgeFundie strategy? Yeah, I have. And I've been meaning to do, because I've been asked about this, and I've been meaning to do a video on it, maybe an article. It's kind of a risk parity strategy, which I'm not a fan of. At the same time, over certain periods of time, they can do really well. This, if you Google HedgeFundie's strategy, this is one of the first results you'll get. This is sort of where it came out of, and you can read all about it. Let's see if they show the portfolio quickly. Actually, you know where we can go for the port. There's another optimized portfolio did. See, it's a 3x on the S&P. See, whenever you start getting into these complications, and a Treasury 20-year bond, which right now would be not really be a great time to buy that, I wouldn't think. It's just, I don't know. That all of that makes me pretty nervous. But there it is. You can read up on it, and I'll work on a video. I have to do more research on it. All right. So Displaced Hoosier wants to know my thoughts on the Vanguard Wellington fund. I mean, it's done really well. I've never owned it. I think it's a 60-40, right? It's an actively managed fund. So I think the oldest mutual fund. Yeah, look at this. It was founded in 1929. That's even older than I am. Okay. 24 bips, which is cheap for an actively managed fund. And if you look at the portfolio, I think it's 60-40, right? Yeah, actually 66-35. And it's done really well. I mean, some would see this as maybe, and this is actually the investor shares. We go to Admiral shares, which I guess would be cheaper. Yeah, 16 bips. Some would see this as the kind of thing where you can just put all your retirement money in this, like in an IRA or whatever, and you're good to go. And I can't argue with that. My concern, I'm just more comfortable in index funds. But this fund has done well. If we look at performance, it's a little hard to think about performance because it's a balanced fund, right? It's not just all stocks. But when you look at 10 years since inception, well, this says this is the the Admiral shares, but the investor shares should go back further. Yeah, look at that. Since 1929, 8.5%. Boy, that's pretty good. Again, for a balanced fund, it's done extremely well. One thing I want to look at is the bond style. Okay, so the stock style is large value, which is consistent with my own approach, even though growth has outperformed value the last 10 years. And the bond style is, so this would tell me that it's intermediate term, so duration's probably, we could look it up, probably 6-7 years, I'm guessing. And it's a mix of treasuries and investment grade bonds. That's my guess based on that. VWELX. Let's look it up. We go to portfolio. Actually, we should just do this every time we look at a fund now. Let's go to distributions. So look, it distributes some capital gains. Not a problem in an IRA, right? But you want to think about that before you put it in a taxable account. And that would be true anyway, because it's got a lot of bonds potentially, right? But anyway, go to portfolio. And since it's a balanced fund, you get a choice up here. We want to look at bonds. Now this shows slightly different, right? So it's funny that it does. It's under 8, the effective duration. And remember, that generally means that if interest rates go up by 1%, the value of this fund goes down by 8. If rates go up 2%, the value of the fund goes down by 16. It doesn't work like that forever, but that's generally what happened. And of course, if interest rates go down by 1%, the value of the fund goes up by 8. Of course, that's if that happened all at once, the immediate effect. But over time, say with rising rates, it's eventually going to benefit from the higher yields, right? Just takes time, and yeah, it's all investment grade, and yeah, treasuries and corporates primarily. Hold some cash. So anyway, that's the fund, and I mean it's done well. I can't argue with its performance. I just get a little nervous with actively managed funds. All right. What bond is the best for a taxable brokerage account? A bond ETF, Vanguard? Well, depending on your tax bracket, I like municipal bond funds. I actually own, not that this is any reason for you to own it. Maybe this is a reason for you to avoid it. You ever think of that? VTEB, right? Vanguard tax exempt bond ETF. Here it is. They have mutual fund versions, right? But I like tax exempt fund. It depends on your tax bracket. If you were in like the 10% tax bracket, this might not be the best option. But if you're in the top bracket, we're not. But if you were in the top bracket, the higher the tax bracket you're in, the more valuable this becomes, right? Because when you compare what you would earn from this with no taxes, with say a treasury or corporate bond, well, maybe a treasury, let's say, where you'd pay some taxes, the more you'd pay in taxes, the more this looks even better. But that's what I use. I think that's a good way to go. Again, you got to assess your tax situation. Oh, I own I-bonds in a taxable account, right? I bought our allotment for this year just the other day. I'll pay taxes, 7%, guaranteed, safe as an investment as we can get, short of paying down debt, I suppose. So John says, outside of individual stocks, I have 7 index funds, and he lists the tickers. They look like all Fidelity funds. What one index fund from Fidelity or Vanguard is best to replace it in totality? Whew. I don't know. How would we even think about that question? Well, let's see here. It's getting late. I don't know if I'm up for this one. We'll try. So we're going to create his portfolio. He didn't mention percentages, but that's okay. He's got FXNAX. What's that? Oh, US bond. Okay. He's got FXAIX. That's the S&P 500. FZILX. That's the international, that's the zero fund, but it's an international fund. FZIPX, which is also a zero fund, that's extended market. So this covers large US companies. Extended market would cover mid cap, and I guess small, maybe small too. I'd have to look it up. VZIPX, let's just double check. I did a video on these funds not that long ago. FZIPX. Did I say V? Go to portfolio. Whoops, I did not want to click that ad. Portfolio. Go to the weight. Yeah, so small and mid cap. All right, good. FOCPX. I have no idea what that is. Apparently neither does Morningstar, but this calls it the Fidelity OTC. Did I mistype the ticker? FOCPX. Oh, I must have. My bad. Over the counter? I don't know. Is this like super small? What is this? No, it's super big growth. Huh. Hang on for a second. I don't know what this is. So we're going to go over to Fidelity. %80 of its assets and securities principally traded on NASDAQ. Oh, okay. And the over-the-counter market, which has more small, and that's what I thought. That's why I said small and medium-sized companies. But when you look at it here, it's huge. That's what the over-the-counter market's usually small companies, investing more than 25% of total assets in technology. Well, anyway, it's it certainly got some huge companies. Maybe if we go to the weight, we'll see a mix. No, this is that's odd. I don't know the over-the-counter part of it. Okay, anyway, I'm not sure how we're going to factor that one in. FNCMX, NASDAQ. Well, Fidelity or Vanguard best to replace this. So if you think about this portfolio, I don't know what your percentages are. That would be really important, right? But you've got a bond, US bond index, total bond fund. You've got large cap, right? And you've got extended market. So these two here, you could think of as just like a total US stock market, right? VTI or VTSAX or Fidelities. And then you've got international, right? So these four funds are kind of like a core portfolio. You've just split the total US market into two funds, right? So with this, you could do, let's ignore these two for a moment, right? You could do, so we could do a life strategy fund, right? Again, the percentages you'd need to know. But if you do life strategy funds, and I'll show you this, go to Vanguard. See, if you invest in these funds, you get a nice little hanging chair, and you can just relax and eat cherries all day long. That's the idea. And they have different percentages. I think growth would be, I think, is 80-20, I think. I could be wrong. Here we go. No, it's 80-20. And the others, are more conservative. And this portfolio is going to be simple. It's going to be, I think, 5 funds, maybe. Yeah. Total stock market, international, and then 3 funds for bonds. Now, we haven't factored in these two guys because I'm not quite sure how to do that yet. So that's one option, though, and we'll come back to these 2 funds. For Fidelity, they have what are called, I think, asset manager funds. Do I have that right? Yes. They're the same thing in concept, but they're actively managed. They're not index funds. What we looked at with Vanguard, it holds index funds, right? I think those are all index funds. We can make sure. Index, 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 index. Yeah, all index. Fidelity Asset Manager is right here. And they have different ones. Again, the percentages are percentages of equities, as you can see here. So you could pick your, what allocation you wanted. And if we look at one of these, so here's the ticker, FAMRX. It's 70 basis points, so it's a little more expensive. The Vanguard fund is in the teens, probably, 14. So this one's actively managed. And if you go to composition, you can see what it holds. So this is a little more complicated to understand, I suppose, because it's investing in individual stocks and whatnot. This is not a fund of funds, which surprises me a little bit, actually. But this is kind of accomplishing the same kind of thing, right? The thing you're going to have to figure out is, are these two? And here's the deal. I guarantee you, well, keep in mind that my guarantees on this show are worthless. There really aren't any guarantees, but I'm pretty confident that most of the companies that these funds would own would be in either one of these portfolios, right? Life strategy or asset manager. Just not in the percentages probably that you have, because when you break out one of these funds by itself and put some percentage of your portfolio in it, you're sort of you're getting overexposure to, in this case, the NASDAQ or this fund, which I'm still not really sure what it is. The whole over-the-counter thing throws me, because when you look at its top, I mean, look at this, 55% of the portfolio are these 10 companies, not exactly small cap. And, obviously all of these companies are going to be in either a life strategy fund or Fidelity asset manager fund. So I think, without doing any research beyond what I've just shown you, one of those two, you asked about Fidelity and Vanguard, one of those two would probably be the one fund solution that would come as reasonably close to this, obviously subject to what percentages you picked, at least that I'm aware of. Whew. Okay. Gotta wake up. I know you guys are thinking, yeah, we do too, Rod. This show needs a little more excitement. Should we play some chess? I don't know. Haven't done that in a while. Bingo knows. That's who asked. It says, not a question. I just wanted to say that I press the play all videos tab and let your videos play in the background right before I go to sleep. That is so kind of you. I wonder if that's really my wife with a fake YouTube account. Probably. By the way, if it helps, I do the same thing. All right, Vicky, this is not my wife. How do you get your knowledge investing? Your education and profession isn't in the industry, so I'm guessing you taught yourself everything. No mentor. That's a really good question. So yeah, I was an English major, then I went to law school. So what good does that do? I was sort of in the industry, kind of. I mean, I was in the securities industry because I was in the enforcement division of the Public Company Accounting Oversight Board, which taught me a lot about financial statements and SEC requirements and auditing. But you're right, it doesn't really teach you anything about the kinds of stuff we're talking about. And it's just been self-taught over 30 years. I read a lot. I've invested for our money for the last 30 years. I did run a personal finance site starting in 2007. I've worked for Forbes. I've interviewed a lot of people, and just learned, try to learn a little bit each day. That's it. I'm sure the viewership now goes to 0. What a clown. Everyone signs off. I didn't take any classes. Yeah. I've been to the Berkshire Hathaway meeting. Does that count? That's definitely a class worth taking. So Cameron wants to know, do you feel that the wheel strategy in retirement using SPY is a good retirement income solution? Not for me. I mean, maybe I could do a video on my thoughts on that. Any of these sort of income producing strategies, whether it's options, whether it's covered, I guess this is options, but covered call ETFs or high dividend yield. Let's find some fund that pays 5 or 6 or 7%. I think ends up has a good chance of making us poorer, less wealthy, because you give up total return in exchange for the income. So Cameron, I've yet to meet an approach that I think makes sense. I actually bought a book. In fact, someone recommended it, and I'm pretty confident I won't like it, but I bought it anyway. Here it is. How to retire on, hang on, I'm trying to find the cover page, and it just decided to go somewhere else. Here it is. Let me see if I can show you. I don't know, can you see that? There it is. How to retire on dividends, earn a safe 8%, leave your principal intact. I've never heard of a safe investment that leaves your principal intact and earns 8%. I don't know of anything like that, but Brett and Tom, the authors of the book, they will enlighten me. I am skeptical. I mean, if you just step back for a moment. Treasuries are paying, the 10-year treasury is up and it's paying what, 175? What's the 10-year? It was over 180. By that, I mean 180 basis points. But today it's 177. That's a safe investment, right? As safe as we can get. But they've got a safe investment with principal intact that's going to earn 8%? Really? Okay. Neil says you could use silver to ward off werewolves. I prefer steaks. There are steaks? Well, that's a vampire. I'm confused now. But you could, I guess. All right, Ilya. Hello from Florida. Hello. Could you tell which bond ETFs should be in a taxable account? We kind of talked about that a minute ago. And when is the right time to buy them? Well, I'm not sure what you mean by that. I generally like munis in a taxable account for the most part. Again, it's going to depend on your tax bracket. But I'm not sure what you mean by when is the right time to buy them. So maybe you could follow up and give me some clarification on that. Carlos says hello from San Antonio. Hello, I've been to San Antonio. It's been a long, long time. As I recall, it was hot. Okay, I'm way behind, and I've only got 3 more minutes. Man, I think I could do this show every single day. Well, I probably couldn't. I would collapse, but. You mentioned when you rolled over your 401k, you received a form that broke out your contributions. What form is that called? It was actually just the check stub. Yeah, it wasn't I guess it really wasn't a form. So I scanned it, I have it, and I'm mailing it now to Fidelity. All right. Vinyl says, I own Alibaba. What do you really own? What rights do you have? The answer is nothing and none. Well, at least for a U.S. company, I do have rights and I do own things. In their case, you do. I guess the question is whether those can be taken away. But I guess if you look back in history, anything can happen anywhere. Mark, wanting to change stock bond allocation over time towards retirement. Is there a way to model this transition from 100% stocks to 65-35 over a certain time period? Maybe personal capital. I don't know what you mean by model what part of that transition. Like if you made that transition over the last 10 years, what would have been the returns? I can't think of anything. I don't think new retirement does that. I'm pretty sure personal capital doesn't. I don't know, Mark. If I come across a tool, I will let you know. I'm not sure. Carlos, I've held Apple for a long time also, but I sold some of it a year or so back to buy HD. Oh, Home Depot, of course. Since it seemed like a good investment. Well, I mean, I think it's done pretty well, right? Let me pull it up in. Over the last year, let's see. A year ago, it was trading at 282, and now it's at 363. It's not bad. Let me show you something. I may have mentioned this in the last live call. I can't remember, but I was listening to, his name now escapes me, but he runs Cliff, I think is it Cliff Capital? He's a value investor. And he was talking about volatility. And he was pointing out, if you look at a stock, like let's take Home Depot. I mean, this doesn't seem like the most volatile of stocks. I mean, it's Home Depot, for goodness sake, right? Yeah, I think I did point this out last time. It's 52-week low, 246. It's high, 420. That's a lot of volatility. What's another company you wouldn't really think of as volatile? How about Ford, right? 10 and 25. That's a pretty big range. Pepsi, 128 and 177. A lot of money can be made with boring stocks. You just have to be patient. Wade wants to know the difference between the QQQ. Let's pull that up. Which is the Invesco QQQ Trust, right? And I'll bring this up in just a second. Morningstar is giving me trouble. So I'm going to show you this in a second. Bear with me. Bear with me. I don't know. Yeah, there's basically, the question is QQQ and QQQM. And if we look, first of all, at the portfolio, here's the top 10 holdings of QQQ, right? And here's QQQM. Yeah, they're basically identical, right? You go to the quote page. I think one is cheaper. Am I right about that? I've never owned either. This expense ratio, QQQ, is 20 bips. This one is 15. I don't know why that is. Why would that be the case? Yeah, I mean, the basic difference is the fee. So I don't know if there's another difference. That's what I thought it was, but that doesn't, I mean, it's like you think there's got to be something else. Maybe there is, but I'm not smart enough to see it. All right, I'm going to do one more, and then I'm going to call it, I'm going to call it a day. And I know I haven't gotten to all the questions, and I'm sorry. I'm doing the best I can. Oh, this is a tough one. So Kelly says, love your show, first time catching the live. My question, what is the best way to get rid of a Vanguard target fund in a taxable Vanguard account? Well, so the problem is when you sell, you're going to trigger presumably some capital gains, right? You certainly want to avoid short-term capital gains if at all possible, but even if they're long-term, you're going to pay taxes. So you have to figure out, depending on how much the capital gains are going to be, does it make sense just to sell it all at one time, or maybe over years, so you can spread out the sales. Obviously, depending on your income, if you can fit it into the 0% capital gains bracket, then that's a no-brainer. That's what you want to try to do. But again, your finances may not allow that. Maybe you're making a lot of money. You're just going to try to fit it into the 15% bracket, not go into 20. And you've got to factor in the 3.8% on Affordable Care Act tax, which again, depending on your income, you may hit, you may not. It may be, that your tax hit could be so bad, you're just going to live with it and hope that what happened in 2021 doesn't happen again. That's an option. So there's no one answer to your question. I would try to map out as best I can the tax consequences of selling all at once, selling over a couple of years. And I talk to a tax, if I need to, I talk to a tax pro to help me. If my taxes are complicated enough, and I don't know your situation, talk to a tax professional, try to figure that out. The one thing I'll add to that And Slim Dog, I don't have a salty update. He's missing in action. You've got to really be careful what you invest in a taxable account, because what happens over time is, hopefully, and this is good, you build up all of these unrealized capital gains. The problem is it then becomes a tax bill to switch. And, depending on your circumstances, you say, well, it's more of a timing issue. I'm going to have to pay capital gains eventually. I'll bite the bullet. But others might say, no, I was kind of going to just leave this to my children and hopefully they would get stepped up basis. And so now what do? You're sort of stuck, or you're paying taxes you wouldn't have otherwise had to have paid. And I've made some mistakes in taxable accounts, and I've talked about them in the past. I mean, fortunately for me, they've not been killer. But I would have done things a little differently, particularly in 2018 when I had some money to invest, if I were doing it over again. So you just, you got to be super careful. But Kelly, to your question, I would just sort of try to brainstorm what your different options are, what the consequences are if you sold all at one time, like in 2022. What if you sold over a 2 or 3 year period, depending on your tax situation? And I would talk to a tax accountant. Depending on how much you have invested, it might be worth spending a few $100 to get an hour of someone's time to walk through your best strategy. But what your best strategy is just going to depend on your specific circumstances. There's just no sort of one answer to that. You could have losses from something that you could offset against the gains, possibly. Maybe you've invested in crypto. You got a lot of losses. But being serious, that could offset some gains. So that's a thing to consider. But again, you might not have that. So there's just so many possibilities. You just have to really think through what they are and talk to a tax pro. Yeah, I wish I could just give you one answer. Just do this and there you go. But it doesn't work that way, I'm afraid. So, well, there you go. That was our first nighttime live Q&A. I think it went pretty well. I don't know. I hope you guys enjoyed it. I will be back Thursday morning at 11 a.m. Whether I'll do this again, I can't imagine doing this every Monday because it's just, I'm exhausted. But I'll certainly do it again. And I'll give you as much notice as I can. So I hope everyone has a great week. I see that I've missed some questions. I'm sorry. But hopefully you can join again Thursday at 11 a.m. or the next time I do an evening one. So those are the options. Have a great week. And until next time, remember, the best thing money can buy is financial freedom. See ya.